Gaurav Mehta is joining us, Chief Investment Officer Alternatives at SBI Mutual Fund. Gaurav, good afternoon. Thanks a lot for joining us. It's good talking to you after a really long time. Of course, our earlier interactions were when, you used to head the trading desk at Edelweiss, right? So good to be talking to you, Gaurav. What's your view on the market now, given the current happenings, and how would you sort of approach it incrementally from here?
Good to speak to you also, Anuj, after a long time. And just a small correction here. So I was earlier a part of Ambit's investment advisory arm before I moved to the mutual fund a few years ago. Yeah. But, coming to markets, obviously, it's been very interesting times last few months. If you think of broader markets for India, at least the story is a little divided. If you think of it from a longer term point of view, we all know that the global economic order is being reshaped, and what you're seeing incrementally is that a lot of erstwhile prominent economies are now struggling for their place in the global order. And that is some spot that economies, especially like India, are steadily but surely sort of trying to capture. So that long term continues to be very promising for India. But I think that said, we shouldn't also wish away whatever we are seeing with respect to short term macro concerns. And again, most of them are global in nature, but with a large part of the global economy struggling, it's difficult to see how, even though on a relative basis will withstand that better, but on an absolute basis, I think we will also face some of those concerns coming from a weak global macro. And then, if you round it up with our own valuations, we tend to look at valuations for equities with reference to where the risk-free rate in the system is. So when you look at the 10-year GSEC at 745, then obviously the current equity valuations look a bit on the expensive side. So I think there's this tug of war, an interesting long-term prospect, but from a near-term point of view, global macro headwinds, and then a bit of expensive valuations. And I think that tug of war is what you've been seeing playing out for almost a year now. We've seen these sharp 10-15% corrections. We've seen these sharp rallies like we saw over the last 2 months. But end on end, I think we've largely been flat. So I guess, I won't be surprised if this volatility continues for a bit longer. The important point is that we shouldn't get too pessimistic when chips are down. And similarly, we shouldn't get too optimistic on the kind of rallies that we've seen over the last 2 months. So this is a time, I think, to continue sticking to your longer term asset allocation.
All right. Hi, Gaurav. Nigel on this side. I think we have spoken numerous times about the nifty additions and deletions, I think, in the past as well, quite a few years ago, if that was the case. But you said, shouldn't get too optimistic and pessimistic. For the time being, it appears chips are down, at least in the near term. If that's going to be the case and we're going to be going through a period of volatility, what are the sectors, the themes that you like from here on?
Right. So I think one segment that we particularly like is, this entire theme around disinflation, because I think the headlines over the last several months have been captured by this high inflation globally. You've seen commodities cool off some bit, but what you've also seen is that central banks across are particularly resolved with respect to taming inflation. So I think we won't be surprised that going forward, inflation does start to come off, even though, that will come at the cost of economic slowdown. So for markets as a whole, the volatility will persist. But within that, I think themes that benefit from disinflation is something that we are interested in. And in that sense, I think domestic consumption is something that stands out. If you think of the entire sort of post-pandemic world, there was this Western world which was giving a lot of fiscal support to its residents, and those residents then consumed thanks to that fiscal support on the other side of COVID. And that in turn is partly responsible to the inflation problem that you're seeing today. But when you think of emerging markets like India, we obviously didn't have the wherewithal to give exactly the same amount of fiscal stimulus that the Western world gave. So to that extent, there was income disruption, and then inflation came through, which in turn meant that real disposable income was eaten into. So in a way, it was the Western consumer crowding out the global consumer. I think with disinflation, that should reverse. So consumers in countries like India should get benefit of that. And again, in India, if you think of it, the urban consumption piece or the high-ticket consumption piece is something that has held up well on the other side of COVID. But it's the rural or semi-urban consumption that's been particularly hit hard by high inflation. So I think that's one pocket that we are now gradually starting to nibble into, because as inflation comes up, I think semi-urban and rural consumption should also pick up, whether it's low-ticket discretionary consumption, whether it's consumer appliances, and so on. So that's one pocket that we are clearly positive on. The other theme, which again is a longer term theme that we continue to like, is this entire manufacturing theme. And clearly, I mean, India is emerging as the preferred, or at least the alternative destination for global companies. You can again sort of dissect manufacturing into sub-themes like garmenting and specialty chemicals and whatnot. But that's again one theme that we continue to be positive on.
Anything that you're avoiding right now, Gaurav, in this market?
Right, so I think overall for the good part of this year, we've been avoiding a lot of these outward-facing sectors, information technology being one of them. And clearly valuations in some of these names have moderated quite a lot versus where they were a year or so ago. But still, you know, from a timing point of view, given the persisting macro uncertainties globally, we still are not too sort of constructive, and we would sort of wait out this period of pain before we get into some of these external facing sectors like tech or you know, materials for that matter. So I think those clearly are avoids at the moment.
Gaurav, hi, Prashant here. So as head of the alternatives business, this would the style of investment be different? I mean, just to understand a little bit about whether you're a long only sort of a mandate, right, Gaurav?
Yeah, so we run both PMS strategies as well as AIF strategies. On PMS, the mandate is long only, and we run very concentrated portfolios there, 20-25 stocks, not more. And the investment horizon is typically very long. On the AIF side, we have a long short fund as well, wherein we can sort of alter allocation depending on our asset allocation frameworks. And those asset allocation frameworks are largely centered around valuations, overall market sentiment, and earnings momentum. And you know, these frameworks for us have been telling us to be underweight on equities for a good part of the past 12 months. And that's the stance we continue to carry forward in the long short strategies. On the long only PMS strategies, we continue to be as invested as a typical long only fund.
Okay. So on the AIF side, we already spoke about what you like. So what don't you like, you know, not like enough to short? That's the...
So, I mean, ours is a very different kind of a long short strategy wherein we short only through Nifty futures or through Nifty derivatives. But as I said, right, we have absolutely no exposure to tech in that fund. We have absolutely no exposure to materials in that fund. We have very low exposure to consumer staples. So those are the pockets that we continue to sort of dislike and hence avoid. Not outright shorts, obviously, because that's not the mandate of the fund.
Okay, so how much is your long short now? I mean, you only would short Nifty, as you said, not even Bank Nifty, right? I mean, only Nifty.
Absolutely.
Okay, so how much is your long short?
Right. So today, you know, again, and I'll just go back to my framework. So on market sentiment, we have a quantified way of looking at market sentiment. We were very euphoric about 12 months ago, but thanks to the correction of the past 12 months, our market sentiment reading has now come back to neutral zones. And I think that's something that you can see. The amount of IPO market activity has obviously softened. The frauds that were there across the market spectrum are now, you know, in limited pockets, and there are quite a lot of pockets that are now providing opportunities. So the sentiment piece is neutral. Earnings, I think you could argue that from a longer term point of view, we are at the beginning of an earnings recovery cycle, because if you look at corporate profits to GDP in India, they were secularly declining between 2008 and 2020 for a good 12-13 year period. But over the last 2 years, profits to GDP have started inching higher, and earnings typically, you know, trend for a pretty longish period of time, 6, 7, 8 years at one go. So to that extent, you can make the point that on earnings, we are at early stages of an earnings recovery cycle, even though, as I said, right, from a 2 to 4 quarters point of view, when you look at fiscal policy across the world, when you look at monetary policy across the world, or when you look at credit conditions across the world, all of those things are pointing to earnings deceleration in the near term. But from a longer term point of view, you know, it's again a question of what is your investment horizon. And then the third pillar is valuations, which I said is expensive. So, you know, we are allowed to move between 0 to 130% on this fund. And today, as we speak, will be somewhere closer to 50% in terms of overall allocation. Our neutral level is closer to 70%. So we've been carrying a below neutral allocation for ever since, you know, as I said, for a good part of the past several months.
All right. Gaurav, thanks so much for stopping by, giving us your view on markets and a whole host of sectors. Look forward to having a chat with you in the time to come. Well, for the time being, the markets, you know, we pulled back a little bit from the low point of the day.